Good afternoon. We're here today because Nora's clients need more than what a 60-40 stock-to-bond portfolio can deliver, especially when you consider the income, stability, and tax efficiency that they hired us for. And while our clients' needs are evolving, the industry has already moved. A 10 to 15% allocation to alternatives is now the standard. We've fallen behind, not because we lack opportunity, but because we haven't chosen the right partners yet. Our team's mandate was simple, but not easy. Evaluate the private real estate universe, select 2 funds worthy of onboarding, and build an allocation strategy tailored to Nora's clients: high net worth, income-oriented, tax-sensitive investors. After vetting 8 funds, performing full scope diligence, and analyzing liquidity, leverage, sector exposure, and downside scenarios, one thing became clear. NREC and NREC are the 2 products that best fit our platform and our clients.
So, as we get into it, let's start by talking about why alternatives like private real estate are an important part of every investor's portfolio. We see really 3 main benefits. First of all, private real estate offers strong returns with smooth volatility compared to the rest of portfolios. Second of all, our investors want income-based products as part of their portfolios, and so we see that real estate offers durable cash flows that also helps to provide some resilience for their portfolios in cases of inflation like we're seeing in times like these. And then finally, private real estate offers low correlation to the equities and bonds that our investors primarily hold in their public portfolios. And so private real estate will serve to lower the total portfolio risk that our investors face. Finally, for us at Nora, this is an exciting opportunity to bring some more assets under our management and be able to increase our fee revenues. So data shows that real estate has a strong place in every portfolio because it helps clients to boost the returns that they were able to get while actually lowering the risks that they have to undergo. Finally, we think this is a really exciting time for our clients to add real estate to their portfolio because we see a combination of steady GDP growth, plateauing yields, and also moderating inflation. And this creates a really exciting window that our clients can take advantage of with a few exciting new options.
And I'm excited to present those options to you today. First, NREC. NREC is a debt fund that focuses on core assets. They use a whole loan strategy where they go fund 80% of a project cost, and then on the back end, they actually go get financing for about another 80%. They either use co-senior originations or a warehouse loan in order to do that. Next, we've got NREC, which also an open-ended fund. It's a private real estate investment trust that is highly diversified, great manager. Next, we looked at SCRET. SCRET is a little slightly less diversified private real estate fund, also a closed-end fund. And they target a little bit higher returns. They go after Core Plus, and we evaluate all of these and more going forward. Starting with NREC, our debt fund, one that we do recommend. The biggest strengths for this is it's an equity-level return with a debt-like risk. Also, it inherently has a built-in interest rate hedge. In times of volatility, they even have a SOFR floor to catch themselves. The biggest weaknesses are really just the characteristic of what it's flowing through to our investors and the fact that it's ordinary income, which we all know gets taxed at the highest rates for them. Second, just there's an annual liquidity event for them. They can't just get their money out anytime they want. It's an annual tender offer with just a couple-day window, which is a new thing for our investor base. But the biggest opportunity we see here is that it's just an alt-light option for them where maybe someone's not so used to taking the risks that equity in real estate could give them. Let's give them a debt option. It's less risk, durable income. The biggest threat here is that they do have a life science tenant that's 4% of their GAV, gross asset value, and they have 2 years left on that loan, And the tenant, it has a little bit less than 2 years left on how long they are there. Based on if they renew or not, we evaluate what that could do to that fund going forward.
Next, taking a look at RCREIF's 5-year outlook, we ran 3 different scenarios looking at a bear, base, and bull with levered IRRs ranging from a 5.7 in the bear up to an 11.46 in the bull, with the base shaping out at an 8.63 return. The IRR compression in the bear case is driven by the life science default, a decrease in property values during refinances, and a softening of profit spreads between the whole loan and senior loan. With the base case, we assume stable market conditions, little fluctuation between property values during refis, and a conservative renewal probability for the life science tenant. Lastly, moving on to the bull case, the IRR expansion was driven by the life science tenant renewing, an increase in property values during refi, and a strengthening of profit spread between the whole loan and senior loan. This meant more cash being deployed, making those returns increase. Moving on to RCREIF's fund snapshot and cash flows. The fund is allocated into 2 different financing vehicles, the senior co-origination and the warehouse borrowing. We really want to highlight the 2.3 years of debt maturity. This gives the fund nimbleness to allocate funds towards different asset classes as they see fit on a shorter term, because even though they're highly allocated towards multifamily and industrial, they're able to allocate funds elsewhere given market conditions. This 2.3 years of debt maturity also allows the fund to generate a lot more income given the origination fees due to refinances as well as extensions. We also want to highlight the 3.3% SOFR floor. This is a great interest rate hedge given rates when they drop or if they drop, really creating stable, durable income. With that, Norwell Solutions, we recommend allocating funds towards RCREIF given their target returns of 8 to 9%, really highlighting those equity-like returns with the debt-like volatility.
So we would like to take a moment to further discuss SCREIT and the decision that our team came to not recommend it as the fund going forward. As you guys are aware, one of the strongest things when it comes to SCREIT is the management team, which is able to hit the hurdle rate of returns due to the strong management. We believe this is recognized specifically in the fact of trading at a 5% discount in the secondaries market, which offers liquidity that our clients would be interested in when it comes to a private investment. With that said, there are some strong weaknesses here that worry us. The lack of diversification when it comes to the Sunbelt market specifically is one that we find as a going concern, especially given the amount of supply increase that market has had. We believe this is further shown due to the loan-to-value ratio going from 45% up to 60%. There is some opportunities to move away from the Sunbelt market, specifically in their interest of moving into the development process in gateway cities. With that said, while our team does like the gateway cities for low vacancy and high rent growth, we are not sure if they will be able to execute in the 5-year time frame that the fund has remaining due to lack of experience within this market. Finally, the biggest threat that we see is the 40% renewal rate that there will be on the mortgages in the next 12 months. We wanted to do a deeper dive and see how that would affect cash flows going forward. As you can see on the right here, our team put together a cash flow summary chart for the industrial and multifamily portfolio. We wanted to analyze this due to the fact that while this is a stabilized fund, they are currently only at 60% AFFO coverage. We find, through a sensitivity analysis, moving interest rates to projections for next year, that the fund is going to be looking at an annual increase of $5 million for interest rate expenses, which is something that concerns us going forward. We decided to also take a look at the investment thesis that the team has going forward and analyze that. So their team has decided to move into a value-add strategy as well as development within the gateway markets. While the team, specifically SCREET, has had success with value add in the past, as you can see here on the MSCI chart, it has been one of the worst performing sectors on a 10-year rate from 2013 to 2023. We're worried that with their specialty focus within the Sunbelt market, that those areas have already seen a run-up in rent growth and will not be able to support a value-add strategy. When it comes to development within the gateway markets, you can see here it is one of the most difficult markets to receive a permit in. Given the fact that they have no prior experience with developing within these cities, we are worried that they will be able to execute in a 5-year time frame that they have. Finally, we wanted to circle back to liquidity. As you guys know, the 5% discount to NAV in the secondaries market is one of the positives that we highlighted earlier. With that said, that is not very common. 25% discount to NAV is much more common in the secondaries, and we are worried that given the investment thesis that they have going forward and the debt wall that they are facing in the next year, that their trading in the secondaries market is going to move to industry norms, which will offer a lot less comfort to us for our clients, which is why we have decided not to recommend this fund going forward.
NREC is our core equity anchor, durable, diverse, and managed by a top-tier institution. This is broad, high-quality core real estate, which benefits from prudent leverage and consistent structured liquidity. Now, NREC doesn't come without its weaknesses. The two main watch points is the exposure to a troubled regional mall and low cash balance, which slows liquidity during redemption periods. But these risks are contained. The mall only makes up 3% of gross asset value, and historically, NREC has fulfilled redemption requests within 2 quarters. We see real upside in their early overweight into specialty sectors, which should position the funds to keep benefiting from their continued outperformance versus core and Odyssey. On that note, Odyssey investors have faced redemption pressure, which has created some price dislocation and potentially strategic acquisition opportunities for NREC as they prioritize dry powder. Lastly, the retail stabilization plan offers meaningful upside if executed well. The 3 threats that we have our eyes on include the anchor tenant leaving the mall, triggering co-tenancy clauses and causing a decline in NOI, single-tenant data center concentration into one hyperscale tenant, and lastly, just broader liquidity issues across core funds. But it's important to note that these are asset-level threats and don't necessarily undermine the broader portfolio's durability. We believe that NREC offers durable income, multi-sector exposure, and risk that we can underwrite.
Next, we forecasted returns in a 5-year horizon for NREC. Starting with our bear at 5.9 unlevered IRR, we are forecasting a macro softening, reducing the NOI growth and expanding on exit cap rates. We're assuming a $30 million capex for the mall and still that anchor leaving. Additionally, we're forecasting a forced sale situation where NREC has to sell at a 5% discount to cover redemptions. In our base, we have 8.5% unlevered IRR. We're assuming stable NOI conditions and exit cap rates, no forced sales, no capex on the mall, but that anchor renewing. For our bull, we're at 10.1% unlevered IRR. With better than expected macro conditionings, compressing the exit cap rate, and a higher NOI growth than our base. For the mall, we're projecting $30 million capex in a fully stabilization situation and covering redemptions with operations instead of any forced sales. Next, we go to NREC's fund overview. One of the key points that our team really likes about NREC is that it's fully diversified across all real estate sectors. It's 60% core and 40% specialty. Specialty has outperformed core, giving the institutional managers that exposure to outperforming the index. We also like that each specialty sector is less than 10% allocation, reducing that risk exposure. We believe these managers can quickly outweigh any sector that's performing really well to take advantage of that momentum. Another reason our team recommends NREC is because of its reliable annual liquidity. They've been able to fulfill redemptions within 2 quarters, and that is still going to be the case. The last point we're recommending NREC for is its limited downside risk, with the bear case being at 5.9 IRR and the base at 8.5 unlevered IRR.
So in order to maximize after-tax returns, it's not just about picking the right funds, it's about placing them in the right accounts. Our CREF generates 100% ordinary income and doesn't benefit from tax mechanisms like return of capital or depreciation. So placing it in an IRA eliminates tax drag. NREC is the opposite. It benefits from mechanisms like return of capital, long-term capital gains, and depreciation. So holding it in the typical taxable brokerage account is a tax-efficient way. Now, combining these 2 strategies really gives Nora's clients the best of both worlds. They get tax-free compounding on credit and tax-advantaged compounding on equity. Now, beyond our CREF and NREC, we believe there's a complementary way to grant Nora's clients access to private real estate without onboarding liquidity risk or operational burden: a private net lease income fund. Net lease structures are long-term leases offering bond-like income backed by investment-grade and credit-worthy tenants. They're extremely stable. As you can see in the example up here from Oak Street's, now owned by Blue Owl, net lease fund, they collected 100% of rent in their portfolio, even through COVID. These assets are extremely low volatility. They offer tax benefits through depreciation, and they give high net worth clients exactly what they're looking for in an investment: predictable yields and downside protection. We're not positioning this as one of our 2 key recommendations today, but we believe it's a high quality, scalable access point for Nora's clients once this private real estate platform matures.
In summary, we are recommending to move forward with 2 funds, our CREF and NREC. Our CREF and NREC, both open core funds, 1 debt, 1 equity, will be the 2 cornerstones of private real estate allocations for Nora going forward. We do believe we should pass on SREIT at this time. The debt wall is something that is very hard for us to want to be comfortable with telling our clientele that they should invest into. But we are really excited about continuing to look into a net leased fund. We think that that is something that could really round out our portfolio of options for our client, as well as really hit exactly what they want and really durable income with appreciation tied to it. Now, allocation into private real estate, it's not an if question for our clients, it's a win. It's going to happen. It's backed by strategy and research. We know that with this new allocation, it's going to help them get better returns, less risk, and on the way, it's going to increase our AUM and our fees as well. To create this future, we need the right partners. We believe we found them for you. We're ready for any questions.